In this video, I'm going to show you the 10 biggest mistakes that people make with their stock portfolio and how to avoid them. Hi, welcome to Money Invest. In this video, I'm going to show you the 10 biggest mistakes that people make with their stock portfolio and how to avoid them. This information is crucial if you want to protect your investments and grow your wealth over time. So please sit down, relax, and watch this video all the way through. It could mean the difference between retiring comfortably or not. If you enjoy this sort of content, please like it, subscribe, and enable notifications so that you do not miss out on any new investing news and tips. Please keep in mind that the info in this video is educational content and not financial advice. It's no secret that the epidemic attracted a flood of new investors wanting to get their hands on the market. In fact, a Charles Schwab study discovered that 15% of all current U.S. stock market investors started trading in 2020. The epidemic provided the ideal opportunity for investors to get in, as stock prices fell and savings account rates dropped. Many young people were left at home with nothing else to do after their jobs dried up during the pandemic. Even with a small amount of money, you may now start investing, since many brokerage firms now provide accounts with no restrictions and zero commission trading. But just because you can start investing with very little money doesn't mean you should. In fact, many first-time investors make mistakes that could ruin their portfolios. So here are the 10 biggest mistakes that new investors make and how you can avoid them. Mistake number 1: chasing the trends. Investors are always looking for the next big thing. They want to find the companies that are going to take off and make them rich, so they chase the latest trends, plowing their money into hot new sectors like tech or mining. The problem is that chasing trends is a recipe for disaster. By the time most investors realize that a particular sector is on the rise, it's usually too late to make any real money. The stocks have already soared and the early investors have cashed out. The latecomers are left holding the bag when the bubble finally bursts. The perfect representative of this investment strategy in 2021 was GameStop, which rose over 400% within a single week and eventually reached a value of $483 per share, up from its 52-week low of $3.77. That stock, on the other hand, currently trades at around $158 per share, indicating a 67% loss for those who got in just last month. Although this method is thrilling, it isn't something you should rely on to fund your retirement, since it essentially amounts to gambling. So, if you're thinking of chasing the latest trends in the stock market, think again. It's a surefire way to lose money. Mistake number 2: not diversifying your portfolio. Another big mistake that new investors make is not diversifying their portfolios. They put all their eggs in one basket, investing in just a few companies or sectors. This is a risky strategy because if one of those companies or sectors tanks, your entire portfolio could go down with it. That's why it's important to diversify your investments, spreading your money across different asset classes, industries, and even countries. This way, you'll be protected if one particular sector or company takes a hit. And as an added bonus, diversification can also help you achieve higher returns over the long term. Mistake number 3: constantly watching the markets. Many people mistakenly believe that they need to constantly watch the stock markets in order to be successful investors. However, this could not be further from the truth. In reality, trying to time the market is a recipe for disaster. Not only is it impossible to predict short-term movements, but even professional investors struggle to outperform the market over the long term. Instead of endlessly monitoring stock prices, it is far more effective to develop a diversified investment plan and stick to it. By investing regularly and holding for the long term, you are much more likely to achieve your financial goals. Constantly watching the stock market can lead to emotional investing, which in turn can lead to poor decisions. Investors who are successful over the long term adhere to a strict investment plan and don't allow their emotions to get in the way. As Buffett told Becky Quick in an interview with CNBC, "I know what markets are going to do over a long period of time. They're going to go up, but in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt that was important." If you've enjoyed this video so far and want to give the algorithm more data to crunch, consider clicking that like button as it helps our channel grow. Mistake number 4, not having an exit strategy. Many investors fail to develop an exit strategy before they even start investing. They buy stocks and hold on to them, regardless of what happens in the markets. This is a dangerous strategy because it leaves you at the mercy of the markets. If the stock market crashes, you could be left holding on to worthless shares. That's why it's important to have an exit strategy in place before you even start investing. Decide what your goals are and when you want to achieve them. Then, develop a plan for selling your investments and realize your gains or losses. By having an exit strategy, you will take the emotion out of decision-making and be more disciplined about when to sell. Mistake number 5, not doing your homework. Investing without doing any research is a recipe for disaster. Yet, many people still make this mistake, especially when they are first starting out. They see a stock that is going up and they buy it without knowing anything about the company. This is a dangerous strategy because you have no idea if the stock is actually a good investment. You could be buying into a company that is about to go bankrupt, or you could be buying shares of a worthless penny stock. Either way, you're taking a big risk with your money. Before you invest in any company, make sure you do your homework. Read the latest news stories, check out the financial statements, and listen to earnings calls. By doing your research, you can separate the wheat from the chaff and avoid making costly mistakes. Mistake number 6, not having a budget. Another mistake that many investors make is not having a budget. They invest without knowing how much they can afford to lose. This is a dangerous strategy because it puts you at risk of financial ruin. If the stock market crashes and you have all your money invested, you could find yourself in a very difficult situation. To avoid this, it is important to have a budget in place before you start investing. Decide how much money you can afford to lose and stick to that number. By having a budget, you will be more disciplined about your investing and less likely to make careless mistakes. Mistake number 7, delaying investing altogether. One of the biggest mistakes you can make when it comes to investing in the stock market is delaying investment altogether. By keeping all of your money in a bank account, you risk losing purchasing power due to inflation. Many people believe that they need to have a large sum of money saved up before they can start investing, but this isn't the case. Even if you only have a small amount of money to invest, it's important to start sooner rather than later. The longer you wait, the more miss out on potential returns. In addition, delaying investment means missing out on the opportunity to benefit from compounding. This is when your returns are reinvested and begin to earn returns on their own. Over time, compounding can have a dramatic effect on your portfolio value. So if you're thinking about putting off investing in the stock market, remember that time is of the essence. Mistake number 8, not having an emergency fund. Another mistake that many investors make is not having an emergency fund. An emergency fund is a savings account that is used to cover unexpected expenses, such as a job loss or medical bills. Many people mistakenly believe that they can use their investment portfolio to cover these types of expenses. However, this is a risky strategy because it puts your investments at risk. If the stock market crashes and you need to sell your investments to cover an unexpected expense, you could end up losing a lot of money. To avoid this, it is important to have an emergency fund in place before you start investing. This way, if something unexpected happens, you will have the money you need to cover your expenses without having to sell your investments. Mistake number 9, holding on to losing positions. A common mistake that investors make is holding on to losing positions. No one wants to sell their stocks at a loss, but sometimes it's the best thing to do. If a stock is consistently losing value, it's unlikely to turn around and start going up again. It's important to cut your losses and move on, rather than keep throwing good money after bad. Even if you believe that a stock will eventually rebound, it's often best to sell it and invest the money elsewhere. Holding on to losing positions can tie up your capital and prevent you from making money in other areas. Don't be afraid to sell stocks that are going down. It may be the best decision you can make. Mistake number 10, being impatient. Many investors hold the unrealistic hope that an investment, such as a stock or fund, will rise immediately after purchase. In reality, the stock market's long-term average return is only 10%. That is, if you're expecting an average return, your stock will take a whole year to go from $30 to $33. Of course, the stock market's long-term average of 10% is just a long-term average. It's conceivable that even if you invest in an index fund, you'll lose money over the short term. Consider it this way. If you invest in a stock or fund that loses 10% the first year, 20% the next, and returns 85% in year 3, you'll have approximately your 10% yearly return. Patience is required when it comes to earning your returns from your investments, and selling at the wrong moment might result in you missing out on a significant future profit. So, which of these mistakes have you made? Thanks for watching. I hope these tips were helpful. Please like and subscribe if you want more content like this.